Would the Federal Reserve be playing smart if it took things slow, as Julie Hyman was just describing, or will its efforts to kickstart the economy prove to be too weak to be effective? Well, we've assembled a taking stock think tank, some experts. Christian Thwaites is the president and chief executive of Sentinel Investments with a mere $23 billion under management. And we have Peter Andersen running a not too shabby $5 billion at Congress Asset Management. Gentlemen, welcome to Bloomberg Taking Stock. Kristen, so what do you make of this idea of the Federal Reserve coming in and actually buying treasuries and trying to stimulate the economy by doing so?
Well, I think it's a policy which is somewhere between desperate and reckless. And,
desperate and reckless?
Somewhere between the two. Desperate because they've literally run out of monetary tools. For the last 2 years, since November 2008, we've had this zero interest rate policy. We've been buying mortgage-backed securities. We've been trying to sterilize the money supply growth by going into the securities market. We've driven rates down as far as they can. So they've really run out of any tools to do. We have fiscal policy in hibernation, so they're really this is the only thing left for them to do. And reckless because this could set off not only a big depreciation of the dollar, because it is going to flood the financial markets with dollars. They're going to be absorbing securities and putting money back to the banks, and the banks will then turn around and probably put it directly into securities markets, which means we'll have inflation in all but name. Maybe not in the CPI, but certainly in assets.
Peter, do you agree?
Well, the only good thing I think you can say about it is the Fed has kind of taken a little speed off the ball by saying they're not going to do this shock and awe anymore. And I think that shows at least that they're thinking if they flooded the market with purchases right now, most investors might become so shocked that there's no awe left, and they would be very concerned because, as Christian referred to, they're kind of at the end of the stepladder in terms of a stepladder approach to fixing the economy. So if they did this wholeheartedly with $1 trillion or so purchases and it didn't work, what would happen next? So I think there's some thought behind pulling back a bit, but I'm still somewhat concerned about it. And I also think that the market has reacted in a way that is kind of an instantaneous poll about their actions.
Christian, why is this a big deal, though? Because if the Federal Reserve, as you described, comes in and actually starts buying these securities, you make it sound as if it's not going to help the economy. It's just going to create a lot of bad consequences. Why would all the consequences necessarily be terrible?
Well, they won't all be terrible. I mean, because they're going to be the buyer of first resort on treasuries. They've already soaked up the mortgage-backed securities market with the first QE. So the only thing that they can really buy is treasuries. It's not going to be buying corporates. So that's going to depress the market in somewhere between the 7 to 15 and maybe out to the 30-year yield. And that will generally lead to a lot of sort of monetary stimulus in the economy. But I don't think it's going to go through to the real economy, which is really what they want. They've said that they want inflation. This will get inflation eventually, but it won't hit the real economy in terms of employment, housing, manufacturing, industrial output, the things that really matter.
We want to get to the real business of the country. It's just going to stay on the balance sheets and on the trading books of a lot of firms.
And it's good for stocks, I think, because the money is going to end up in the most liquid asset class after treasuries, which happens to be stocks.
Well, all right, Peter. So if we take the Federal Reserve at its word, at least right now, that it's going to be gradual, that means we really don't know what's going to happen. So people looking for stocks have to think about stocks that are, in a sense, not only bulletproof when it comes to the Fed's actions, but also what happens next week when everyone goes to the poll and votes.
I think you're referring to perhaps election-proof stocks.
Yes, election-proof stocks. What do you suggest that people look for? Well,
what I tell people is to look the same way you always do. Look for companies that have great balance sheets, good income statements, and especially dividend-producing stocks right now. It might be the end of the bond bull market, as you referred to earlier, but that might not be that bad a thing because bonds have outperformed, and I'm kind of looking forward to when they do get back to their regular routine of maybe 2 to 4% a year. In the meantime, for investors who are looking to supplement that income, look for high dividend paying stocks. There's a bunch of them out there in terms of large cap space. Philip Morris International, of the large tobacco concern, pays 4.5% dividend. And what's interesting about it, Pimm, is the dividend is higher than its bond yield. Very unusual right now to find stocks whose dividend yield is greater than their corporate bond yield. Their bond yield is 3.5%, where the dividend yield is 4.5%. I would urge investors to look at that quite seriously. Very steady Eddie type performance, great balance sheet. They are going to buy back stock, and they continuously raise their dividend year after year. Another name that's in that category would be ConocoPhillips. That's got a dream come true because it's buying back stock, increasing the dividend, and just looks very, very strong from any angle you look at from a financial perspective. So while the elections, there's a lot of uncertainty in that, and even the Fed's actions, you still can find stocks out there that probably will perform independently of the election results.
All right, so Philip Morris International, as well as ConocoPhillips. And Christian, you know, Peter raises this idea that companies are selling bonds at yields below, in this case, what Philip Morris International is paying as a dividend on the common stock. So is this a case that investors should do what the companies are doing themselves, but don't do what everyone is saying, which is go to bonds, but go ahead and buy the stocks, particularly if they're offering dividend and growth?
Yeah, I absolutely agree with that. And we've got this sort of rather strange arbitrage right now where companies can raise 5- and 10-year money at less than their dividend paying, and sometimes that's because their profits are locked up in tax regimes which are lower tax than the US. To repatriate them back in order to buy stocks would be a very big tax hit to shareholders. So consequently, they're issuing bonds in order to finance the stock repurchases. And we saw Microsoft do that, and we saw Johnson & Johnson. And I think that's a good thing to look out for, because that's going to shrink the equity base for the existing stockholders.
Well, we had the news today from Visa after the market closed that they're going to increase the amount of stock repurchase.
Yeah. And IBM mentioned that as well.
$10 billion program. $10 billion.
And another one that we like in particular is Nike, where you get a huge growth kicker. It's getting about 25% of its sales from emerging markets in China. Those sales are growing about 25%. It's more mature markets about 8 or 9%. But they're barely into a 5-year stock repurchase program, which will probably shrink the equity base by about 20%. So I think balance sheet sort of cleanliness and good access to capital markets and good coverage and low leverage will be a very good recipe for stock buyers.
Now, you've just come back from, what, about 3 weeks on the road? Yeah. You've been spending some of the time in China, and I know that you come back with one name particularly on the retail front, PARKSON. And this is a retail emporium that is all throughout China, and indeed it's based in Hong Kong. But when you look at their website, they talk about themselves as a foreign retailer going into China.
Yes. They're a Malaysian company who own the parent company owns 51% of PARKSON Retail, and they have the Hong Kong listing. But this is, I think that the Chinese consumer domestic play is going to take many years to play out. It's a very bullish story. And PARKSON is one of the premier department store owners and operators in mainland China. And it's a great play on the tier 2, 3, and 4 cities, and way beyond the sort of Shanghai, Beijing corridor, which is pretty saturated. So a great company. And here you can get 20-25% growth and a dividend yield of about 1.5%, which has been growing at 22%. So that comes back to the same sort of instructions to buy companies with good balance sheets and good dividends.
Peter, I want to give you the last very small word. Dr. Pepper Snapple, you still like the shares?
Absolutely. And, you know, if listeners are just listening to the summary, they have to be optimistic.
All right. I want to thank you, gentlemen. Peter, Christian, great to have you with us. Coming up.